Hello there, and welcome to the Sleepy Economics channel. Tonight, we drift into the quiet current of an old river, the river of banking, the slow-moving channel through which trust has flowed from hand to hand for thousands of years. Money itself is loud, coins clatter, markets shout, ledgers slam shut at the end of a hard day. But banking, underneath all of that noise, has always been something gentler, a quiet agreement between strangers that a promise, once written down, can be trusted long after the moment it was made. For most of human history, that single idea, that trust can be stored, carried, and passed on like a lit candle, has shaped how civilizations rose, how they traded, how they survived their winters and their wars. Tonight we will wander slowly through that history, from the mud brick temples of the ancient world to the marble halls of early modern banks, pausing in 100 small rooms where someone, somewhere, chose to trust a stranger with their grain, their gold, or their future. If you find these slow walks through history helpful for drifting off, it would mean a great deal if you considered liking this video or subscribing to the channel so that more of these quiet nights can find you. For now, there is nothing you need to do but listen. Let your shoulders soften into whatever is holding you. Let your jaw loosen, your breathing slow, your thoughts drift like slow water over old stones. You do not need to remember anything you hear tonight. You only need to rest. Let's begin. Long before there were coins, there were granaries, and it was inside those granaries that banking quietly began. In ancient Mesopotamia, more than 4,000 years ago, temples stored the surplus grain of entire communities, and priests kept careful clay records of what belonged to whom. A farmer could deposit his harvest for safekeeping and later withdraw an equivalent amount, or have it transferred to someone else entirely, all without a single seed physically changing hands in that moment. Yet this convenience came with a quiet vulnerability. The whole system depended on the priesthood's honesty and on the fragile clay tablets that recorded every promise. Even in these earliest days, trust was already the true currency, long before metal ever was. Imagine a scribe in the city of Uruk pressing a reed stylus into wet clay, recording a loan of barley between two neighbors who could neither read nor write themselves. These small transactions, repeated countless times across the Fertile Crescent, formed something remarkably close to a banking system, complete with interest rates set by custom and law. The Code of Hammurabi, carved in stone in the 18th century BCE, even fixed limits on how much interest a lender could charge on grain or silver. Still, for a farmer facing a bad harvest, even a modest, legal rate of interest could mean the slow loss of land, tools, or freedom itself. There is something quietly moving about a civilization choosing to write its economic rules into permanent stone, as if hoping fairness itself could be made to last. Silver, unlike grain, could not rot, and this simple fact changed everything about how ancient peoples thought of wealth. By the 2nd millennium BCE, silver rings and ingots of standard weight were being used across Mesopotamia and Egypt as a stable measure of value, long before anyone had thought to stamp an official coin. Merchants weighed silver on hanging scales in the marketplace, checking purity by touch, by sound, by the trained eye of long experience. Yet weighing silver was slow, and dishonest traders sometimes shaved metal from the edges of ingots or mixed in cheaper alloys.
Out of that very inconvenience, the idea of a guaranteed, standardized coin would eventually be born, though it would take many more centuries to arrive.
In the temples of ancient Babylon, one particular family name still echoes through economic history: the Egibi. Records show that this family operated something close to a private banking house for generations, lending money, financing trade caravans, and managing property on behalf of wealthy clients. Their business survived political upheaval, foreign conquest, and the rise and fall of kings, quietly continuing its work of moving wealth from those who had it to those who needed it. And yet, even a family this established was not immune to bad debts, defaulting clients, and the occasional ruinous loss. This is what makes it so quietly remarkable, that a private banking dynasty, run by ordinary people rather than kings or priests, could function so smoothly in a world without paper money at all. Trade caravans crossing the deserts of the ancient Near East could not carry heavy sacks of silver for thousands of miles without risking theft or loss. So merchants developed early instruments of credit, written promises redeemable at a distant city, carried by trusted couriers instead of coin. A trader in Assur could issue such a promise to a partner in a distant outpost, who could then use it to settle debts locally, all resting on nothing but reputation and a shared written language of trust. Bandits along these desert routes remained a constant danger, and a single robbed caravan could ruin a merchant family for a generation. Even in the earliest chapters of commerce, distance itself was the great problem that banking, in all its later forms, would spend thousands of years trying to solve.
Yay! Ancient Egypt built its own quiet version of a banking system, resting not on coins, but on grain stored in vast state granaries along the Nile.
Farmers deposited their harvest after the annual flood receded, receiving a written receipt that could later be used to pay taxes, settle debts, or purchase goods from another depositor's account. These receipts moved from hand to hand, almost like paper currency, even though the grain itself never left the granary walls. Yet the system depended entirely on the honesty of scribes and officials, and a corrupt record keeper could quietly erase a farmer's life savings with a single false mark.
Even a river as generous as the Nile could not protect its people from the oldest economic danger of all, a broken promise.
Then, in the 7th century BCE, something changed the shape of money forever. In the kingdom of Lydia, in what is now Western Turkey, craftsmen began stamping small lumps of electrum, a natural blend of gold and silver, with official royal symbols. For the first time, a piece of metal carried a guarantee of weight and purity stamped directly onto its surface, sparing merchants the slow ritual of weighing and testing. Still, counterfeiters soon learned to imitate these stamps, and kingdoms had to constantly refine their methods to stay ahead of forgery.
This is what makes it so fascinating, that the very invention meant to simplify trust immediately created a new, more sophisticated form of deception to guard against.
Coinage spread quickly along the trade routes of the ancient Mediterranean, carried by merchants, soldiers, and travelers who found it far easier than bartering goods directly. Greek city-states began minting their own coins soon after, each stamped with local symbols, an owl for Athens, a horse for Corinth, turning currency into a quiet form of civic pride. A trader could recognize at a glance which city stood behind a coin's promise of value, long before he ever reached that city's gates. Yet different coinages meant different weights and purities, and international trade still required money changers who understood the subtle differences between them.
Over time, this need for expertise gave rise to an entirely new profession, one that would eventually be called banking.
Imagine a bustling agora in ancient Athens, filled with the low murmur of bargaining voices and the clink of coins on wooden tables. Here, on simple benches called trapezai, money changers sat ready to exchange foreign coins, test their purity, and offer basic loans to merchants preparing for a voyage.
The Greek word for these benches, trapeza, still echoes today in the modern words for bank across several European languages.
Yet these early bankers operated with little formal regulation, and a dishonest money changer could ruin a merchant's entire venture with a single bad exchange. It is a strange thought that the very word we use for a bank today began as nothing more than a simple wooden table in a crowded, noisy square. Some of the earliest formal banking in the Greek world actually took place inside temples, particularly the great sanctuary of Delphi and the Temple of Artemis at Ephesus. These religious sites were considered sacred and largely immune from plunder even during war, making them natural places to store wealth safely for merchants, cities, and private citizens alike. Temple priests effectively acted as bankers, accepting deposits, making loans at set rates of interest, and keeping meticulous records inscribed on stone or papyrus. Even sacred ground, however, was not always safe, and history records more than one desperate general who violated a temple's sanctity to fund his war. There is something quietly telling in the fact that even the gods, in the ancient imagination, were trusted to keep humanity's ledgers straight. Rome inherited much of its financial vocabulary and practice from the Greek world, but built something larger and more systematic on top of it. Roman bankers, known as argentarii, operated from small stalls near the forum, offering currency exchange, deposit accounts, and loans to a growing empire hungry for capital. They kept detailed daybooks, recording every transaction with a precision that would look almost familiar to a modern bookkeeper. Yet Roman law offered depositors surprisingly little protection, and a bank's collapse could wipe out an ordinary citizen's entire fortune overnight. Even an empire capable of building roads across 3 continents could not fully guarantee the safety of a single coin left in another man's care. By the 2nd century BCE, Rome had developed something resembling a wholesale credit market, where wealthy senators quietly lent enormous sums to provincial governors, tax farmers, and foreign kings. These loans, often carrying steep interest, financed wars, public works, and the lavish lifestyles of the Roman elite. The famous orator Cicero once complained bitterly in his letters about the crushing debts owed by entire provinces to Roman lenders.
Yet this same system of credit, so useful to the powerful, often devastated ordinary farmers who fell behind on smaller, humbler debts.
So over time, debt became one of the quiet, corrosive forces that widened the gap between Rome's richest citizens and everyone beneath them. The Roman Forum itself held a stretch of shops and stalls known as the Argoletum, where much of the city's early banking business was conducted in full public view. Here, transactions were witnessed openly, disputes were settled loudly, and reputation mattered as much as any written contract. A banker caught cheating a client could find his business ruined within days, as word spread through Rome's tightly woven social networks. Still, this reliance on reputation offered little comfort to travelers or foreigners who lacked the local relationships that protected native Romans. In this sense, banking in the ancient world was never purely financial. It was always, at its core, a deeply social act of trust. Imagine a Roman merchant preparing for a long sea voyage to Alexandria, uncertain whether his ship would survive the crossing at all. To manage this risk, Roman law allowed for a special kind of loan called Finis Nauticum, a maritime loan that only had to be repaid if the ship completed its journey safely. If the vessel sank, the debt sank with it, and the lender bore the loss instead of the merchant.
In exchange for this shared risk, lenders charged extraordinarily high interest rates. sometimes far above the legal limits set for ordinary loans on land.
It is a quietly elegant solution, this ancient sharing of fortune and misfortune between two strangers bound only by a written agreement. Roman banking eventually reached remarkable sophistication, with some historians describing a form of check-like payment order used between distant branches of the same banking house. A wealthy Roman traveling to a provincial city could arrange for funds to be available there without carrying dangerous quantities of coin across hostile roads. This required correspondent relationships between bankers in different cities, each trusting the other's word enough to honor a written instruction from a stranger. Yet, as the empire grew unstable in its later centuries, this fragile web of trust between distant bankers began to fray along with everything else. This is what makes the fall of Rome so quietly haunting for economic history, an entire sophisticated financial network slowly dissolving back into fragments. Roman coinage itself told a quiet story of decline that many citizens never fully understood while it was happening. Emperors, desperate to fund armies and public spending, gradually reduced the silver content of their coins, replacing precious metal with cheaper alloys while keeping the face value the same. Ordinary people noticed their coins looking dull and gray rather than bright silver, long before they understood the deeper cause. Prices for basic goods began climbing steadily, and the value of savings quietly eroded year after year without any single dramatic event to blame. There is a slow, patient lesson in this, that trust, once diluted even a little, tends to keep dissolving until someone finally decides to rebuild it properly. By the time the Western Roman Empire finally fell in the 5th century, its once vast banking networks had already been unraveling for generations. Trade routes grew dangerous, cities shrank, and the specialized profession of the argentarius slowly faded from daily life across much of Western Europe. Coins continued to circulate, but the sophisticated credit instruments and correspondent banking relationships of the High Empire largely disappeared. Communities that had once relied on distant trade turned inward, toward smaller, more local, more self-sufficient economies. Even the grandest financial systems, it turns out, are only as strong as the roads, the armies, and the trust that quietly hold them together. Yet banking never fully vanished, even in Europe's difficult centuries after Rome's collapse, because human beings never stopped needing to lend, to save, and to trade across distances.
Monasteries across early medieval Europe quietly took on some of the old temple's financial role, storing valuables, managing estates, and occasionally extending credit to nearby communities.
Monks kept careful records in Latin, continuing a tradition of literate bookkeeping that had nearly disappeared elsewhere in society. Still, the scale of this activity was tiny compared to Rome's old imperial economy, confined mostly to a single abbey's modest lands. In this way, a quiet ember of financial practice kept glowing through Europe's darkest centuries, waiting patiently for trade to revive. Meanwhile, in the East, the Byzantine Empire preserved and even expanded upon Roman financial traditions from its capital in Constantinople. Byzantine gold coins, known as solidi, became so trusted for their consistent purity that they circulated as a kind of international reserve currency across the Mediterranean and beyond.
Merchants from India to Britain accepted these coins without hesitation, confident in a standard the empire had guarded for centuries.
Yet even this remarkable stability eventually cracked under the pressure of wars, plagues, and shrinking imperial territory. Even the steadiest currency in the ancient world, it turns out, could not outlast the empire that stood quietly behind its promise. Across the Islamic world during this same period, Banking and commerce flourished with remarkable sophistication, stretching from Spain to Central Asia along vast trading networks.
Merchants developed early forms of the check, called a sak, a written order allowing a merchant in one city to draw funds from an account held in another, sometimes thousands of miles away.
Islamic scholars also debated carefully the ethics of lending and interest, shaping financial practice through religious law in ways that still influence banking today. Yet enforcing these written promises across such vast distances required immense trust in local partners, correspondence, and the honesty of strangers. It is worth pausing on this quietly, that so much of what we now call modern finance grew from centuries of careful, patient thinking about how strangers could trust one another across an ocean of distance. As medieval Europe slowly rebuilt its trade networks, one persistent obstacle stood in the way of a fully developed banking system: the Church's teaching against usury.
Christian doctrine held that charging interest on a loan was a sin, since it seemed to profit from time itself, which belonged only to God.
This left a curious gap in medieval economic life, one that other communities, less bound by this particular prohibition, would eventually help to fill.
Yet even devout Christian merchants still needed credit to finance trade, harvests, and the unpredictable costs of daily life.
Even a rule meant to protect the soul, it turned out, could not fully hold back the practical needs of a growing economy.
Into this gap stepped Jewish moneylenders across much of medieval Europe, a role shaped as much by exclusion as by choice.
Barred from many guilds, professions, and forms of land ownership in Christian kingdoms, Jewish communities were often pushed toward finance as one of the few livelihoods still open to them. Figures like those depicted in later English history, such as the historical moneylenders of medieval York or London, became essential yet deeply resented sources of credit for kings and commoners alike. This arrangement was precarious, and Jewish lenders frequently faced heavy taxation, sudden expulsions, and violent persecution whenever debts grew politically inconvenient for the crown.
It is a difficult, sobering thread in this story, one worth acknowledging honestly, that some of medieval banking's foundations were built upon a community's exclusion as much as its expertise.
The kings themselves became some of history's most notorious borrowers, often defaulting on debts owed to the very financiers who had helped fund their wars.
Edward I of England expelled the kingdom's entire Jewish population in 1290, a decision closely tied to the crown's tangled and unpaid debts.
Later English monarchs would find new lenders, from Italian merchant bankers to their own increasingly powerful nobility, only to fall behind on those debts as well.
A king's promise, however solemnly sworn, was rarely as reliable as a common merchant's, since no court could easily force a monarch to pay. Even now, centuries later, there is something quietly instructive in watching the most powerful men in medieval Europe struggle with the same basic problem as any ordinary borrower: the simple difficulty of paying back what was owed. Imagine a network of warrior monks sworn to poverty, who nonetheless became some of medieval Europe's most trusted bankers. The Knights Templar, founded to protect pilgrims traveling to the Holy Land, developed a remarkable system allowing travelers to deposit funds at one Templar house and withdraw an equivalent sum at another, thousands of miles away. This early letter of credit system spared pilgrims the danger of carrying gold through bandit-filled roads, relying instead on a coded document and the order's formidable, continent-spanning reputation. Yet this same wealth and influence eventually made the Templars a target, and in the early 14th century the French crown, deeply in their debt, moved to destroy the entire order.
There is a quiet, cautionary irony here.
that even an organization built on sacred vows could not protect itself from the oldest financial danger of all, a powerful debtor unwilling to pay. By the 12th and 13th centuries, Italian city-states had begun to develop financial techniques far more sophisticated than anything seen in Europe since Rome's fall. Merchants in cities like Genoa, Venice, and Florence needed ways to finance long trading voyages without physically transporting large sums of gold across dangerous seas and mountain passes. Out of this need grew early partnerships, insurance contracts, and double-entry bookkeeping, a method of recording transactions that would eventually spread across the entire world. Yet these innovations also introduced new risks, since a single failed voyage or dishonest partner could unravel an entire family's fortune within a season. So over time, these Italian merchant cities quietly became the true birthplace of modern banking as we would come to recognize it. No family name is more closely tied to the birth of modern banking than the Medici of Florence, though they were far from the first Italian banking dynasty to rise and fall. Before the Medici, the Bardi and Peruzzi families had built enormous banking empires in the 14th century, financing kings, popes, and merchant fleets across Europe. Both houses eventually lent staggering sums to King Edward III of England to fund his wars against France. When Edward defaulted on these massive loans in the 1340s, both the Bardi and Peruzzi banks collapsed, dragging much of the Florentine economy down with them. This is what makes it so quietly haunting, that a single distant king's broken promise could ripple outward and shatter the fortunes of an entire city, centuries before anyone had a word for financial contagion. From the wreckage of these earlier collapses, the Medici family built something more careful, more diversified, and ultimately more enduring. Giovanni di Bicci de' Medici founded the family bank in 1397, structuring it as a network of semi-independent partnerships across different cities rather than one single, fragile institution. If a branch in Rome or Bruges suffered a loss, the damage could often be contained rather than spreading through the entire organization. Still, this structure required constant, careful correspondence between branches, and a single dishonest branch manager could still quietly bleed the family's wealth for years before discovery.
There is a patient wisdom in this design, a lesson still echoed in modern finance, that spreading risk across many smaller parts is often gentler than trusting everything to one great unbroken chain.
Imagine the Medici Bank's headquarters in Florence, its clerks bent over ledgers by candlelight, tracking transactions written in a private code few outsiders could decipher. The bank managed the papacy's own finances for decades, collecting church revenues from across Europe and quietly taking a share for its trouble. This closeness to the church gave the Medici enormous influence, eventually helping several family members rise to political power in Florence itself, and even to the papal throne. Yet mixing banking so closely with politics and religion created constant, delicate risks, since a change in church leadership could instantly upend decades of careful financial relationships. Wealth, in this era, was never purely an economic matter. It was always tangled together with faith, power, and the shifting loyalties of history's most unpredictable institutions. The Medici Bank also pioneered the widespread use of the Bill of Exchange, a written document allowing a merchant to pay a debt in one city using currency deposited in another entirely.
This clever instrument served two purposes at once. It moved money safely across long distances, and it quietly disguised interest payments as currency exchange fees, sidestepping the church's ban on usury.
A merchant in London could settle a debt in Florence without a single coin crossing the English Channel, the transaction existing almost entirely on paper and trust. Yet this reliance on distant paper promises required an enormous, carefully maintained web of trustworthy correspondence in cities across the continent. In this sense, the bill of exchange was not just a financial tool, but a quiet triumph of patient, long-distance human trust over the slow danger of the open road. Even the mighty Medici bank could not escape the same fate that had ended the Bardi and Peruzzi houses a century earlier. By the late 15th century, mismanagement, risky loans to unreliable rulers, and the family's growing distraction with politics had weakened the bank considerably. When the Medici were briefly exiled from Florence in 1494, their once great financial empire finally collapsed for good, its branches shuttered one by one across Europe. Yet the techniques the family had pioneered, diversified branches, bills of exchange, careful double-entry bookkeeping, outlived the bank itself by centuries. Even when the powerful and glittering names fade from history, this is what makes finance so quietly resilient. The patient methods they leave behind so often continue on without them. As trade fairs grew across late medieval Europe, particularly in the Champagne region of France, merchants needed a reliable way to settle debts between buyers and sellers from dozens of different cities. These great fairs became informal clearinghouses, where bills of exchange from distant banking houses could be matched, offset, and settled without vast quantities of coin ever needing to travel. A merchant from Genoa might owe money to one from Bruges, who in turn owed money to another from Florence, and all three debts could sometimes cancel out on paper alone.
Yet this elegant system depended entirely on the fair's organizers maintaining strict order, honest record-keeping, and swift resolution of any dispute.
There is something quietly beautiful in imagining hundreds of tangled debts owed across an entire continent, gently unraveling themselves in the noise and dust of a single autumn marketplace. By the 16th century, the city of Antwerp had emerged as one of Europe's great financial centers, its exchange building bustling with merchants, brokers, and bankers from across the known world. Here, bills of exchange were bought and sold much like commodities themselves, their prices shifting with rumors of war, harvest failures, or a king's uncertain credit. Antwerp's financial innovations included early forms of speculation, where a bill's value might be traded well before the underlying debt was ever due. Yet this same speculative energy made Antwerp's markets volatile, prone to sudden panics whenever confidence in a major debtor wavered. So over time, this restless, paper-driven marketplace quietly became the ancestor of the modern stock exchange, still centuries away from being named as such. Spain's vast flow of American silver, arriving by galleon throughout the 16th century, might have seemed like the ultimate solution to any kingdom's financial troubles. Instead, this sudden flood of precious metal drove prices upward across Europe in a long, slow wave, now remembered as the Price Revolution. Spanish kings, despite receiving more silver than any monarch in history before them, still managed to default on their debts multiple times during this same century. Foreign bankers, particularly from Genoa and southern Germany, grew wary of lending to a crown that treated repayment as merely optional.
It is a quietly ironic lesson from this era that no quantity of raw wealth, however vast, can fully replace the patient discipline of honoring one's debts.
Imagine the counting houses of Augsburg in southern Germany, where the Fugger family built one of Europe's largest banking fortunes, financing the Holy Roman Emperor himself.
Jakob Fugger, sometimes remembered by the nickname the Rich, lent enormous sums to Habsburg rulers, even helping to finance the election of Emperor Charles V in 1519.
The Fuggers diversified their wealth into mining, particularly silver and copper, giving them both financial and industrial power across Central Europe. Yet lending to emperors carried the same old danger as lending to any king. Repayment depended entirely on royal goodwill, rather than any binding legal guarantee. Even the grandest banking fortune in Renaissance Europe rested, in the end, on the same fragile foundation as the humblest medieval loan: a powerful man's word. In 1609, the city of Amsterdam opened an institution that would quietly reshape the future of banking itself: the Amsterdam Wisselbank, or exchange bank. Merchants could deposit coins of wildly varying origin and quality, receiving in return a stable account balance denominated in a single, trusted unit of value. This allowed Amsterdam's traders to settle enormous debts simply by transferring numbers between accounts, without a single physical coin ever leaving the bank's vault. For over a century, the Wisselbank maintained a reputation for near-total reliability, becoming the beating financial heart of the Dutch Golden Age. There is a quiet elegance to this idea that trust itself, carefully and consistently maintained, could become more valuable to merchants than the shifting weight of silver in their pockets. The same Amsterdam that built this steady, trustworthy bank also became home to one of history's most famous financial frenzies, tulip mania.
In the 1630s, prices for rare tulip bulbs rose to extraordinary heights, with some single bulbs reportedly trading for the price of a fine house along the canal.
Ordinary craftsmen and merchants speculated eagerly, buying and selling contracts for bulbs that would not even bloom until the following spring. Then, in February of 1637, prices collapsed almost overnight, leaving many speculators holding contracts worth a fraction of what they had paid. Even the most sober, disciplined financial city in Europe, it turned out, was not immune to the old human habit of mistaking excitement for certainty. Across the North Sea, England's own banking system grew from an unlikely source: the workshops of London's goldsmiths. These craftsmen, already equipped with sturdy vaults to protect precious metal, began accepting deposits of coin and gold from wealthy clients seeking safekeeping.
In return, goldsmiths issued written receipts, which clients soon discovered could simply be passed to others as a convenient substitute for carrying heavy coin.
This is what makes it so fascinating, that paper money, in England at least, was born almost by accident, out of a craftsman's spare vault space rather than any grand royal design.
Goldsmith bankers soon realized they could lend out a portion of their depositors' gold, since rarely did everyone demand their coin back on the very same day.
Imagine a London goldsmith in the 1660s, quietly calculating how much of his depositors' gold could safely be lent to merchants and nobles without anyone noticing the vault growing lighter. This practice, now called fractional reserve banking, allowed goldsmith bankers to earn interest on loans while still honoring most withdrawal requests without difficulty. Yet the system rested on a delicate, unspoken assumption that depositors would never all demand their gold back at once. When rumors of war or royal instability spread through London, panicked crowds sometimes gathered outside goldsmith shops, each desperate to withdraw before the gold ran out.
Even this earliest form of modern banking, quietly born from convenience, already carried within it the seed of every bank run that would follow for the next 3 centuries.
England's financial troubles reached a breaking point in the late 17th century, as King William III struggled to fund a costly war against France.
In 1694, a group of merchants and financiers proposed a bold solution: a new institution that would lend the government a substantial sum in exchange for the exclusive right to issue banknotes.
This new Bank of England was not owned by the Crown itself. but by private investors, a structure that helped reassure lenders wary of royal default.
The bank's notes, backed by the government's promise to repay its debt, began circulating as a trusted form of paper currency across the kingdom. So over time, this careful, almost cautious arrangement between a nervous government and a group of private financiers quietly became the blueprint for central banking as the modern world would come to know it. The Bank of England's early years were far from smooth, and its notes were not always trusted equally in every corner of the kingdom. Rural communities, unfamiliar with paper promises from a distant London institution, often preferred the reassuring weight of gold and silver coin in hand.
Meanwhile, a growing number of private country banks emerged across England, each issuing its own notes, backed by its own reserves, and carrying its own particular risk of failure.
When a local bank collapsed, its notes could become worthless overnight, leaving ordinary tradespeople and farmers to absorb the sudden loss. Even after paper money had proven itself in London's grand financial circles, it would take generations of quiet, patient trust building before it felt truly safe in every village and market town. In the early 18th century, both England and France experienced dramatic financial bubbles that would leave lasting scars on public trust in banking itself. In France, a Scottish financier named John Law convinced the government to let him establish a new bank issuing paper currency, along with a company holding vast trading rights in the Mississippi territories of North America. Shares in Law's company soared to fantastic heights as investors imagined limitless wealth waiting across the Atlantic Ocean.
By 1720, the bubble burst catastrophically, wiping out fortunes across French society and souring an entire generation on the very idea of paper money.
Even a system built by one of history's most brilliant financial minds could collapse, in the end, under nothing more than the ordinary weight of unchecked human hope. England suffered its own painful lesson that same year, in the form of the South Sea Bubble.
The South Sea Company had been granted a monopoly on British trade with South America, and its shares became the object of frenzied public speculation throughout 1720.
Even members of Parliament and the royal family invested heavily, swept along by the same excitement gripping shopkeepers and clergymen across the kingdom. When the bubble collapsed that autumn, thousands of investors were ruined, and the scandal prompted new laws restricting the formation of joint stock companies for decades afterward. This is what makes it so quietly instructive, that the same instinct driving people towards safety and savings can, under the right conditions, just as easily drive them toward ruin. Imagine a London coffeehouse in the summer of 1720, its tables crowded with clerks and gentlemen alike, all trading rumors and stock certificates in the same breath. These coffee houses, particularly one known as Jonathan's, had become informal trading floors where brokers gathered daily to buy and sell shares in companies old and new. Out of this same crowded, noisy tradition, London's stock exchange would eventually take formal shape later in the century. Yet the South Sea collapse left many of these very coffeehouse traders bankrupt, their fortunes evaporating as quickly as the optimism that had built them. There is a strange, quiet symmetry in finance across every century. The same rooms that birth great wealth so often also witness its sudden, painful unraveling. Following these twin disasters in England and France, banking across Europe entered a more cautious, more regulated era, though credit and paper money continued expanding steadily nonetheless. Central banks, insurance companies, and joint stock enterprises grew more common throughout the 18th century, gradually becoming a normal, accepted part of European economic life. Scotland, notably, developed an unusually stable and innovative banking system during this period, with competing banks issuing their own notes under careful, mutually enforced discipline. Even so, wars, harvest failures, and political upheaval continued to trigger periodic waves of bank failures across the continent. Even when institutions grow wiser from past mistakes, this is what makes economic history so endlessly repeating. Human confidence, once restored, tends quietly to forget the very lessons that rebuilt it.
By the late 18th century, the newly independent United States faced its own urgent question. How should a young nation build a trustworthy financial system almost entirely from scratch?
Alexander Hamilton, the first Secretary of the Treasury, proposed a national bank modeled loosely on the Bank of England, along with a plan for the federal government to assume the state's war debts.
This proposal proved deeply controversial, pitting those who favored strong central financial institutions against those who feared concentrated banking power above all else. The resulting compromise and the eventual chartering of the first Bank of the United States in 1791 set the tone for a debate about central banking that would echo through American history for well over a century. Even in a brand new nation built on entirely new ideals, the oldest banking question of all still had to be answered once again. How much trust should rest in a single, powerful institution? The 19th century brought a new kind of financial creature into being, the railway boom, and with it, a scale of banking investment the world had never quite witnessed before. In Britain, thousands of investors poured savings into railway companies during the 1840s, drawn by promises of steady returns from this astonishing new technology. Banks extended vast sums of credit to fund construction, while speculators traded railway shares with the same feverish energy once reserved for tulip bulbs or South Sea stock. When many of these railway schemes proved overbuilt or poorly managed, the resulting crash in 1847 rippled through banks across the country. Even the most modern, most promising invention of an age, it seems, could still tempt investors into the very same old patterns of excitement and collapse. Across the Atlantic, the young United States endured its own repeating rhythm of financial panic throughout the 19th century, a pattern that would eventually reshape the entire national banking system. The Panic of 1837 followed a period of wild land speculation and loose lending by hundreds of poorly regulated state banks, each issuing its own paper currency of uncertain value. When confidence collapsed, banks across the country suspended payments, businesses failed, and a deep economic depression settled over the nation for years. Later panics in 1857, 1873, and 1893 followed strikingly similar patterns: rapid credit expansion, overconfident speculation, and then a sudden, painful reckoning. There is a quiet, weary rhythm to this century of American finance, like a tide that keeps rising and falling along the very same familiar shore. Imagine the autumn of 1907, when a failed attempt to corner the copper market in New York triggered a sudden, terrifying loss of confidence in the city's trust companies. Depositors lined up outside these institutions, desperate to withdraw their savings before the doors might close for good. With no central bank yet standing behind the system, it fell to the private banker J. Pierpont Morgan to personally organize emergency loans among New York's wealthiest financiers, quite literally locking them in a room until they agreed to act.
This crisis, resolved by the will of a single powerful individual rather than any formal institution, left policymakers deeply unsettled about the fragility of American banking.
Even a nation as vast and industrious as the United States, it turned out, could not rely forever on one man's willingness to save it from itself. The Panic of 1907 became the quiet catalyst for one of the most consequential financial reforms in American history. Lawmakers, shaken by how close the country had come to complete financial collapse, began drafting plans for a permanent central banking authority. After years of careful, often contentious negotiation between competing regional and political interests, Congress finally established the Federal Reserve System in December of 1913.
This new institution was designed with a deliberately decentralized structure, spreading power across 12 regional banks rather than concentrating it entirely in New York or Washington.
So over time, this careful balancing act between local independence and national coordination would shape how America managed its money for the century that followed. Meanwhile, throughout the 19th century, much of the world had gradually adopted the gold standard, tying the value of paper currency directly to a fixed weight of gold held in reserve.
Britain formally adopted this system in 1821, and by the century's end, most major economies had followed its example, creating a remarkably stable era of international trade and exchange.
A traveler could carry British pounds, French francs, or American dollars across the world, confident each currency held a fixed, predictable value in gold. Yet this same rigid stability left governments with little flexibility to respond to economic downturns, since expanding the money supply meant finding more physical gold to back it.
There is a quiet trade-off woven through this entire era. The steady comfort of a fixed, trustworthy currency, purchased at the cost of a government's freedom to respond when hardship arrived.
The outbreak of the First World War in 1914 quietly ended the long era of the classical gold standard, as nations rushed to fund the enormous costs of war through borrowing and printed currency instead.
Governments suspended the promise to convert paper money into gold on demand, a wartime measure many assumed would be temporary. Yet after the war ended, attempts to restore the old gold standard often proved painfully difficult, requiring harsh austerity that strained already exhausted economies. Britain's return to gold in 1925, at a rate many economists considered unrealistically high, contributed to years of sluggish growth and labor unrest that followed. Even a system built to provide unshakable stability, once broken by war, proved remarkably difficult to gently put back together again. Then, in October of 1929, the American stock market collapsed, with a suddenness that stunned even seasoned investors, unraveling years of confident, borrowed speculation. Banks across the country, many of which had invested depositors' funds heavily in now worthless securities, began failing by the thousands over the following years. With no deposit insurance to protect ordinary savers, each bank failure meant families losing their life savings in a single, devastating stroke. Fear spread quickly from town to town, as depositors elsewhere rushed to withdraw their own savings before their local bank might fail as well. This is what makes the Great Depression so quietly haunting for the history of banking. Not just the scale of the collapse, but how ordinary trust itself seemed to disappear almost overnight. Imagine a small American town in the winter of 1932, its single local bank finally closing its doors after months of quiet, worried withdrawals. The bank's failure meant that farmers could no longer secure loans for spring planting. Shopkeepers lost the savings meant to restock their shelves, and an entire community's economic life quietly ground to a halt.
Nearly 9,000 banks failed across the United States during the early years of the Depression, a scale of collapse the country had never witnessed before.
Congress and the new Roosevelt administration recognized that restoring public confidence required more than reassuring words. It required a structural guarantee.
Even the deepest financial wounds, history suggests, eventually force a society to build something sturdier from the wreckage left behind. In 1933, the United States created the Federal Deposit Insurance Corporation, a bold new promise that ordinary depositors' savings would be protected even if their bank failed. For the first time, an everyday saver did not need to personally judge a bank's soundness, since the government itself now stood quietly behind every insured account. Bank runs, once a recurring nightmare stretching back centuries to the goldsmiths of London, became remarkably rare in the decades that followed this new guarantee.
Similar deposit insurance systems eventually spread to other nations, each recognizing the same simple truth, that public confidence, once shattered, needs more than words to be gently rebuilt.
There is something quietly moving in this idea that an entire nation might collectively decide to share the risk that had once fallen so painfully on individual families alone.
As the Second World War drew toward its close, representatives from 44 nations gathered at a resort in Bretton Woods, New Hampshire, to design a new framework for international finance.
The resulting Bretton Woods system tied major currencies to the United States dollar, which itself remained convertible into gold at a fixed rate, creating a new kind of global monetary stability. This arrangement also established two new institutions, the International Monetary Fund and the World Bank, meant to help stabilize currencies and rebuild economies shattered by war. Yet by the early 1970s, mounting pressures on the dollar's gold backing led the United States to abandon this fixed exchange system altogether.
So, over time, the world quietly moved into an era where currencies floated freely against one another, their value resting on confidence and policy rather than any fixed weight of gold.
Long before Europe experimented with paper money, China had already pioneered the idea, centuries earlier, out of the same old problem: the sheer inconvenience of carrying heavy coin.
During the Tang Dynasty, merchants began using promissory notes called flying cash to avoid transporting strings of heavy copper coins across long trade routes.
By the Song Dynasty, the government itself began issuing official paper currency, backed by reserves of coin held in state treasuries. Yet this innovation carried its own temptation, and later dynasties sometimes printed far more paper money than their reserves could support, triggering serious inflation.
Even 1,000 years ago, in a civilization thousands of miles from London or Amsterdam, the same delicate balance between convenience and discipline had already quietly revealed itself.
The Mongol Empire, spanning much of Asia in the 13th century, adopted and spread Chinese-style paper currency across its vast territories, astonishing travelers from the West. The Venetian merchant Marco Polo wrote with evident wonder about paper notes bearing the Great Khan's seal, treated with the same seriousness as gold or silver throughout the empire. This system depended entirely on the authority and stability of Mongol rule, since the paper itself held no value beyond the government's promise behind it. When the Mongol Yuan dynasty weakened in the 14th century, confidence in its paper currency collapsed along with imperial authority itself. It is a quietly universal lesson, repeated across continents and centuries alike, that paper money is only ever as strong as the institution willing to stand behind it. Across the Islamic world, and later within the Ottoman Empire, financial practice continued to develop along its own distinctive path, shaped by religious guidance on fair and ethical dealing.
Ottoman moneylenders, known as sarraf, managed currency exchange and credit across a vast, multi-ethnic empire stretching from the Balkans to North Africa. Religious minorities within the empire, including Greek, Armenian, and Jewish communities,
often played prominent roles in this financial life, much as similar minorities had in medieval Europe. By the 19th century, European-style banks began establishing branches within Ottoman territory, gradually blending older regional practices with newer international methods. There is something quietly telling in how, across every culture and century, financial trust so often found its home among communities positioned carefully between different worlds. Imagine the docks of 17th century Amsterdam and London, where a bold new kind of institution was taking shape, the great chartered trading companies.
The Dutch East India Company, founded in 1602, became the first company in the world to issue shares that could be freely bought and sold on a public exchange. Investors, from wealthy merchants to modest shopkeepers, could own a small piece of distant, dangerous voyages to Asia without ever boarding a ship themselves. This innovation spread wealth and risk more widely than ever before, but it also introduced entirely new forms of speculation, manipulation, and eventual scandal. In this single quiet invention, a piece of paper representing partial ownership of distant enterprise, the modern stock market had, almost invisibly, already been born. The English East India Company followed a similar path, growing from a modest trading venture into something resembling a private empire, complete with its own army and its own currency. Its shares traded actively in London, and the company's fortunes rose and fell with news from distant India, carried slowly across oceans by sailing ship. Bankers and financiers in London grew deeply intertwined with the company's fate, extending credit against its expected profits from tea, textiles, and other valuable trade goods. Yet this concentration of financial and political power in a single private company eventually troubled British lawmakers enough to impose stricter oversight in the following century.
Even now, this remains a quietly persistent theme across the centuries. The uneasy, ever-shifting balance between private financial ambition and the public good it sometimes threatens to overwhelm.
While grand banking houses financed kings and merchant fleets, an entirely different, humbler form of finance quietly served ordinary people throughout history: the pawnbroker. Pawn shops trace back to ancient China and continued through medieval Europe, where Italian Lombard merchants became so associated with small secured loans that the very word Lombard became a synonym for a pawnbroker in several languages. A struggling family could bring a valuable object, perhaps a tool or a piece of jewelry, and receive a small loan with the item held as security until repayment. This simple, practical arrangement offered credit to people who could never hope to walk into a grand banking house and be taken seriously. There is a quiet dignity in this kind of finance, small and unglamorous as it was, since it so often stood between an ordinary family and true desperation. The Catholic Church itself eventually softened its long opposition to lending by encouraging a particular charitable institution known as the Monte di Pietà, or Mountain of Piety, beginning in 15th century Italy. These church-sponsored pawn shops offered small loans to the poor at low or no interest, funded by charitable donations rather than profit-seeking investors. The idea spread across Catholic Europe over the following centuries, offering a gentler alternative to the sometimes harsh terms of private moneylenders.
Yet even these charitable institutions required careful management, since poorly run funds could quickly be depleted by unpaid loans.
It is a quietly moving thought that even an institution once so wary of lending eventually found its own gentle way to stand beside the poorest borrowers. Imagine 18th century Scotland, where a schoolteacher named Henry Duncan grew troubled by how little safe opportunity existed for laborers and servants to save small sums of money. In 1810, Duncan founded what is often considered the first modern savings bank, designed specifically to accept small deposits from working people and pay modest interest in return. The idea spread quickly across Britain and then across the world, giving ordinary families, for the first time, a safe and respectable place to store their modest savings. Unlike the grand merchant banks of London, these savings banks required no wealth or connections to open an account, only patience and a willingness to save. So, over time, this quiet, humble innovation did more to bring banking into ordinary households than almost any grander financial invention that came before it. Building societies emerged around this same period in Britain, formed when groups of workers pooled their savings together with the specific goal of helping members afford their own homes. Members contributed regular small sums, and the collected fund was used to grant mortgages to members in turn, according to an agreed order or a drawn lot.
This cooperative model spread to other countries under different names: savings and loan associations in the United States, or credit unions in many other parts of the world.
Yet these institutions depended entirely on the discipline and honesty of their members, and a poorly managed society could collapse just as easily as any grand city bank. There is something quietly hopeful in this particular chapter of banking history, a reminder that finance, at its gentlest, has always also been a way for neighbors to help one another. Postal savings systems offered yet another humble but important innovation, allowing ordinary citizens to deposit small sums at their local post office rather than traveling to a distant bank. Britain introduced its postal savings system in 1861, and the idea soon spread to Japan, the United States, and dozens of other nations across the following decades. For rural communities far from any bank branch, the post office quietly became the most trusted financial institution many families would ever know. These systems often proved remarkably stable, since deposits were backed directly by the government rather than any private, potentially fragile bank. Even the humblest brick post office in the smallest village, it turns out, played its own quiet part in bringing the ancient promise of banking to millions who had never known it before. Insurance and banking grew up as close cousins throughout history, both built on the same basic idea of sharing risk that no single person could safely bear alone. In 17th century London, a coffee house owned by Edward Lloyd became a gathering place for ship captains, merchants, and financiers eager to discuss the latest maritime news and shipping risks. Wealthy individuals at Lloyd's began underwriting marine insurance policies, each pledging a portion of the coverage in exchange for a share of the premium. If a ship was lost at sea, the loss was spread carefully across many underwriters rather than falling entirely upon one ruined merchant. This is what makes it so fascinating, that one of the world's great insurance institutions began not in a formal office, but in the warm, noisy chatter of a simple coffee house. Fire insurance developed along a similarly practical path, spurred dramatically by the Great Fire of London in 1666, which destroyed thousands of homes and businesses within a matter of days. In the fire's aftermath, entrepreneurs established some of the first formal fire insurance companies, offering policyholders compensation and even employing their own private firefighting brigades. Homeowners displayed small metal plaques called fire marks on their buildings to show which company insured the property and would respond in an emergency. Yet early fire insurance companies sometimes overextended themselves, and a single catastrophic blaze could still threaten to bankrupt an insurer entirely. There is a quiet, careful mathematics behind every insurance policy ever written, a patient calculation of how much shared misfortune an institution can safely absorb. Imagine the ledger rooms of 19th century banks, where clerks by the hundreds worked long hours recording transactions entirely by hand, using pen, ink, and careful, practiced penmanship. The check, a written instruction to a bank to pay a specific sum, grew steadily more common throughout this century, gradually replacing coin and even banknotes for larger transactions between businesses. Clearinghouses emerged in major cities, allowing banks to settle the countless checks written between their various customers each day without moving physical cash for every single transaction. Yet this system required immense trust in the accuracy of thousands of clerks, since a single miscalculation could quietly ripple through an entire city's commerce. Even the most modern financial systems of that era, however clever, still rested ultimately on the patient, careful hands of ordinary working people. The 20th century brought a steady wave of technological change to banking, each new invention quietly reshaping how ordinary people interacted with their own money. Mechanical adding machines and eventually early computers gradually replaced the armies of clerks who had once tallied ledgers entirely by hand. The credit card, first appearing in a limited form in the 1950s, offered customers a new kind of convenience, allowing purchases to be made against a promise of future repayment rather than immediate cash. Yet this same convenience introduced a quieter, more personal form of debt into millions of ordinary households, one that would grow steadily more significant across the following decades. So, over time, each new invention in banking's long history has carried this same familiar trade: greater convenience, purchased alongside some new and unfamiliar risk. In 1967, the world's first automated teller machine was installed outside a bank branch in London, allowing customers to withdraw cash without ever speaking to a human clerk.
The idea spread rapidly across the world over the following decade, quietly changing the rhythm of daily financial life for millions of ordinary people.
For the first time, banking no longer required matching one's own schedule to a bank's opening hours, freeing customers to withdraw money whenever the need arose. Yet this convenience also meant the slow fading of a more personal, familiar relationship between a customer and a local bank clerk who had once known their name. Even the friendliest human systems, it seems, are quietly and gradually reshaped by whatever proves more convenient, whether or not anything warmer is lost along the way.
In the aftermath of the Great Depression, American lawmakers passed the Glass-Steagall Act in 1933, drawing a firm legal wall between ordinary commercial banking and the riskier world of investment banking.
Lawmakers believed that banks' gambling depositors' savings on speculative securities had contributed heavily to the crisis that had just devastated the country.
For decades afterward, a commercial bank holding your modest savings account could not also underwrite risky stock offerings the way it had in the years before the crash. This separation brought a long stretch of relative banking stability to the United States, lasting through the middle decades of the 20th century. There is a quiet wisdom in this kind of caution, a society choosing, at least for a while, to keep its safest institutions gently separated from its most adventurous ones. By the 1980s, a different corner of American finance faced its own quiet unraveling. The savings and loan associations that had grown from those same humble 19th century building societies. Deregulation, combined with risky real estate lending and, in some cases, outright fraud, led hundreds of these once conservative institutions toward failure throughout the decade.
The federal government eventually stepped in with a costly rescue, closing failed institutions and reimbursing depositors according to the deposit insurance promises made decades earlier.
This crisis served as a quiet reminder that even the gentlest, most community-minded financial institutions could grow fragile once their old, careful discipline slipped away. Even history's steadiest institutions, it seems, require constant, patient tending, since old caution has a quiet way of fading once a generation forgets why it mattered. Imagine the closing decades of the 20th century as banking gradually stretched beyond national borders into something increasingly global in scope. Advances in telecommunications allowed banks to move enormous sums of money across continents within moments, linking markets in Tokyo, London, and New York into a single, continuous trading day. This new interconnectedness brought tremendous efficiency, allowing capital to flow quickly toward wherever it was needed most around the world. Yet, it also meant that trouble in one distant market could now ripple outward far more quickly than in any earlier century, reaching institutions thousands of miles away within hours. So over time, the ancient dream of connecting distant merchants through trust and paper had finally arrived at its furthest possible extension, an entire world's markets breathing together as one.
Banking traditions outside the Western world developed their own remarkable depth and sophistication, often quietly overlooked in histories that focus mostly on London or New York.
In India, indigenous bankers had long used a credit instrument called the hundi, a written order allowing merchants to transfer funds and settle debts across vast distances of the subcontinent. These networks, often organized along family and community lines, financed much of India's internal trade for centuries, operating with their own carefully guarded codes of honor and practice. European colonial banks eventually arrived alongside these older systems, sometimes competing, sometimes quietly absorbing local practices into their own operations. There is a quiet richness in remembering that trust-based finance grew up independently in dozens of civilizations, each discovering, in its own way, the same essential human solution. Across much of Africa, informal rotating savings and credit associations, known by many local names such as Susu or Tontine, provided community-based finance long before formal banks ever arrived. Members of these groups contributed a fixed sum regularly, with the entire pooled amount going to a different member each cycle, in careful, agreed rotation.
This system required no collateral, no paperwork, and no distant institution, only the patient, mutual trust of neighbors who knew one another well.
Similar community savings traditions can be found across Asia and Latin America, each shaped by local custom yet strikingly similar in their underlying logic. Even today, these quiet, community-rooted systems remind us that banking, at its very oldest and truest root, was never really about marble buildings at all, but simply about people trusting one another to keep a promise. In colonial America, before the nation had any unified currency, colonists relied on a curious patchwork of Spanish silver dollars, British coin, and locally printed paper notes issued by individual colonies. Massachusetts issued the first paper currency in the American colonies in 1690, originally intended to pay soldiers after a failed military campaign against Quebec. Other colonies followed suit, each printing its own notes, often in quantities that gradually eroded their value through steady, creeping inflation. British authorities, wary of this loose colonial money printing, eventually restricted the practice, a policy that quietly added to the tensions building toward revolution. Even the earliest chapters of American finance, it turns out, were tangled up with questions of trust, authority, and who truly held the right to make a promise of value. After the United States finally achieved independence, the young nation went through a chaotic period sometimes remembered as the era of wildcat banking, particularly in its western territories. With limited federal oversight, hundreds of small state-chartered banks issued their own paper currency, some backed by solid reserves and others by little more than optimism and clever printing. Legend holds that some of the flimsiest banks deliberately located their offices in remote areas, supposedly frequented more by wildcats than by customers seeking to redeem their notes for coin. A traveling merchant might carry a thick wallet of banknotes from a dozen different banks, each trading at a different discount depending on how trustworthy that particular institution was believed to be. It is a quietly chaotic, almost dreamlike chapter in monetary history, an entire nation's money resting on nothing more solid than each town's whispered reputation. Imagine the gold rushes of the 19th century in California, Australia, and later South Africa, each one drawing waves of hopeful prospectors and, close behind them, waves of eager bankers.
Mining towns that sprang up almost overnight needed somewhere to store sudden fortunes in raw gold dust and nuggets, and small local banks quickly filled that need. Some of history's most enduring banking names, including institutions that would grow into major national banks, trace their origins back to these rough, hastily built frontier vaults.
Yet frontier banking carried enormous risk, and many gold rush banks failed just as suddenly as the towns around them emptied once the easy gold ran out.
There is a quiet parallel here worth noticing, that banking has always followed wherever sudden human hope gathers, for better and sometimes for considerably worse. War has repeatedly tested banking systems throughout history, forcing governments to find creative and sometimes desperate ways to finance conflicts far larger than their ordinary treasuries could support. During the American Civil War, both the Union and Confederacy issued paper currency to fund their war efforts, though with sharply different outcomes for each side. Union greenbacks, though controversial, retained reasonable value, backed by the growing industrial strength of the Northern economy. Confederate currency, by contrast, steadily lost value as the war dragged on, eventually becoming almost worthless as Southern military fortunes collapsed. Even paper money, in the end, has never truly been backed by ink alone, but by the deeper, quieter question of whether the nation behind it seems likely to endure. The 20th century's two world wars similarly reshaped global finance, as nations borrowed unprecedented sums and reorganized their banking systems entirely around the urgent demands of war production.
Government bonds, sold directly to ordinary citizens through patriotic campaigns, became a central tool for financing these enormous military efforts.
Families who had never before considered themselves investors found themselves holding war bonds, their modest savings quietly woven into the vast financial machinery of national survival. After each war ended, the resulting mountains of government debt reshaped economic policy for a generation, influencing everything from interest rates to taxation. So, over time, the story of banking and the story of war have always moved together, each shaping the other in ways that rarely appear in the celebratory chapters of history books.
Central banks themselves evolved considerably in how they understood their own purpose across the 20th century, gradually moving toward the idea of independence from direct political control.
Early central banks like the Bank of England or the Federal Reserve often found their decisions shaped heavily by the immediate wishes of the government of the day. Over the following decades, many economists came to argue that a central bank shielded from short-term political pressure could better maintain a stable, trustworthy currency over the long run. By the late 20th century, Dozens of countries had granted their central banks greater formal independence, particularly over decisions about interest rates. There is a quiet, careful logic in this evolution, a society choosing to protect its most patient, long-term decisions from the more impatient rhythms of politics. The 1980s brought a painful new chapter to global finance, as a number of Latin American nations found themselves unable to repay enormous debts owed to international banks.
Mexico's 1982 announcement that it could no longer meet its debt payments sent shockwaves through banks across the United States and Europe that held significant Latin American loans.
What followed became known as the Lost Decade across much of the region, as nations struggled through years of austerity, renegotiation, and slow economic recovery.
International institutions, including the International Monetary Fund, played a central role in negotiating new terms between struggling governments and their anxious creditors.
Even the grandest banks in the wealthiest nations, this crisis quietly revealed, remained tied by an invisible thread to the fortunes of borrowers half a world away. Imagine the summer of 1997 as a sudden currency crisis swept across Southeast Asia, beginning in Thailand and rapidly spreading to South Korea, Indonesia, and beyond. Years of rapid economic growth, fueled partly by large inflows of foreign capital, had left many of the region's banks holding risky loans built on optimistic assumptions.
When foreign investors suddenly lost confidence and withdrew their capital, currencies collapsed and banking systems across the region buckled under the strain.
Millions of ordinary workers across Asia lost their jobs as the crisis rippled outward from banking halls into factories, farms, and family homes. This is what makes it so quietly sobering, how swiftly confidence, once shaken in one distant market, can ripple outward to touch lives that never had any part in the original decisions. Europe pursued its own bold and unprecedented financial experiment at the close of the 20th century, gradually building toward a shared currency across many of its nations. After decades of careful negotiation, the euro was introduced for financial transactions in 1999, with physical coins and notes following in 2002 across a dozen founding countries. For the first time since the days of the old gold standard, a traveler could cross several national borders in Europe while carrying the very same currency the entire way. Yet this shared currency also meant that countries with very different economies now shared the same interest rate policy, a tension that would surface painfully during later economic difficulties. There is a quiet, hopeful ambition behind the euro's creation, a modern echo of that ancient dream, that trust, once carefully built, might finally erase the friction of every border it crosses.
Counterfeiting has haunted the history of money since the very first coins were struck, a shadow that has followed banking through every century since.
Medieval kingdoms punished counterfeiters severely, sometimes with death, recognizing that a fake coin threatened the trust underlying an entire currency system.
As paper money spread, banks and governments developed increasingly intricate designs, watermarks, and printing techniques specifically to stay one careful step ahead of forgers.
During the Napoleonic Wars, Britain even faced a wave of counterfeit banknotes deliberately produced by enemy agents, hoping to destabilize the nation's currency and economy.
Even now, this quiet, centuries-old contest between trust and deception continues, a reminder that every promise printed on paper has always needed careful, constant defending. Few banking families in modern history rival the reach of the Rothschilds, who built an extraordinary financial network stretching across Europe beginning in the late 18th century. Mayer Amschel Rothschild, working from a modest house in Frankfurt, sent his 5 sons to establish banking houses in London, Paris, Vienna, Naples, and Frankfurt itself.
This family network allowed information and capital to move across borders with remarkable speed for the era, giving the Rothschilds a quiet advantage in financing governments and trade alike. Legend holds that the family learned of Napoleon's defeat at Waterloo before the British government's own official messengers, though historians debate how much this actually shaped their fortunes. There is something quietly fascinating in imagining 5 brothers scattered across a continent, coordinating an entire financial empire through nothing more than careful letters and family loyalty. Women have played a far more significant role in banking history than many popular accounts acknowledge, even in eras that formally excluded them from most financial institutions. Widows across medieval and early modern Europe frequently managed family banking businesses after a husband's death, sometimes with considerable skill and independence.
In some Italian merchant families, women managed household accounts and even extended credit to neighbors, quietly participating in the same informal financial networks that underpinned formal banking.
Yet formal banking careers, board seats, and ownership remained largely closed to women well into the 20th century across most of the world. It is worth pausing gently on this thread, since so much of banking's patient, careful record-keeping quietly depended on women's labor and judgment, even when history rarely wrote their names into the ledger. Imagine a small village in Bangladesh in the 1970s, where a young economics professor named Muhammad Yunus grew troubled by how little formal credit reached the country's poorest families. Traditional banks required collateral that poor rural borrowers simply did not have, leaving them dependent on informal moneylenders who often charged crushing rates of interest.
Yunus began lending small sums from his own pocket and eventually founded the Grameen Bank, pioneering what came to be known as microfinance. The model relied on small group loans and social trust rather than traditional collateral, extending credit to millions of borrowers, many of them women, who had never held a bank account before.
This is what makes it so quietly remarkable, that one of banking's oldest original ideas, lending built on community trust rather than collateral, could still reshape millions of lives in the modern era.
By the early 21st century, banking had grown into an extraordinarily complex global system, with financial institutions creating increasingly intricate instruments built from bundles of mortgages, loans, and other debts.
Many of these instruments were designed, at least in theory, to spread risk more broadly and safely across the financial system as a whole.
Yet, as housing prices climbed steadily higher across much of the world in the mid-2000s, lending standards in some markets grew quietly looser, extending credit to borrowers less able to repay it. Few at the time fully appreciated how tightly interconnected these complex instruments had become, linking banks across different continents in ways that were difficult to fully trace. Even the most sophisticated financial minds of any era, history suggests, can find themselves surprised by how far a familiar old danger has quietly traveled beneath the surface. When housing prices finally began to fall in 2007 and 2008, the resulting strain revealed just how fragile this interconnected system had become, triggering the most serious global financial crisis since the Great Depression. Major banking institutions across the United States and Europe faced sudden, severe losses, and some, like the storied investment bank Lehman Brothers, collapsed entirely within days. Governments and central banks intervened on an unprecedented scale, extending emergency support to stabilize banks considered too large or too interconnected to be allowed to fail. Millions of families across the world lost homes, jobs, and savings in the recession that followed, a painful reminder of how quickly banking trouble can ripple into ordinary daily life. Even in an age of remarkable technology and sophistication, this crisis quietly proved that the oldest lessons of banking history, caution, restraint, and honest risk, had never actually gone out of date. In the years following the 2008 crisis, regulators around the world worked to rebuild confidence through a new set of international banking standards known as Basel III. These rules required banks to hold larger cushions of capital against potential losses, hoping to prevent a similar crisis from spreading so uncontrollably again. Central banks also expanded their toolkit considerably, using methods like large-scale asset purchases to support struggling economies when interest rates alone were not enough. Some economists welcomed these careful new safeguards, while others worried they might simply delay rather than prevent the next inevitable financial storm. So, over time, each generation seems to inherit this same patient, unfinished task, quietly rebuilding trust after the last storm, while trying to imagine what shape the next one might take. Long before any of these modern debates, philosophers and early economists had already begun quietly puzzling over the deeper nature of money, credit, and banking itself. The Scottish philosopher Adam Smith, writing in 1776, described how a well-regulated banking system could allow a nation's money to circulate far more efficiently than gold and silver alone. He also warned, with remarkable foresight, about the dangers of banks extending credit too freely, comparing sound banking practice to a careful, disciplined household. Later economists, from David Ricardo to John Maynard Keynes, continued this same patient conversation, each generation re-examining old questions about money in light of new crises. There is a quiet, comforting continuity in this, that the deepest questions about trust and credit have occupied careful minds for centuries, long before any of us were born to wonder about them ourselves. Imagine the walled trading cities of Shanxi province in 19th century China, where merchant families built an extraordinary network of remittance banks known as piaohao. These institutions allowed merchants and officials to transfer silver safely across China's vast distances using nothing more than a coded letter and the network's carefully guarded reputation. For nearly a century, Shanxi banking houses dominated Chinese domestic finance, their branches reaching from Beijing to the farthest western provinces. Yet political upheaval, foreign competition, and the arrival of modern Western-style banks eventually eroded this once dominant network in the early 20th century. Even a financial tradition this vast and this trusted, sustained for generations by nothing more than paper, ink, and a shared code of honor, could not outlast the changing tides of history around it. Debasement, the quiet practice of reducing a coin's precious metal content while keeping its stated value the same, appears again and again across nearly every civilization that ever minted currency. Roman emperors did it, as we heard earlier tonight, but so did medieval French kings, struggling Ottoman sultans, and countless rulers throughout history, facing empty treasuries and mounting expenses.
Ordinary people often sense debasement before any official announcement, noticing coins that felt lighter, looked duller, or simply seemed to buy less bread than they once had.
Trust in a currency, once quietly eroded this way, often took far longer to rebuild than it had taken to break in the first place. It is a strange, recurring pattern across the whole of human history. How often the hand that holds the mint is tempted, sooner or later, to quietly bend the very promise it is meant to protect. Markets and fairs across history often doubled as informal courts of financial reputation, places where a merchant's good name could be built up carefully over years, or lost within a single dishonest season.
In medieval and early modern Europe, seasonal fairs became natural moments for settling accumulated debts. Much like the harvest itself marked a natural rhythm for farmers settling accounts with landlords.
A merchant who failed to honor a debt at a great fair risked more than a single lost transaction. He risked being quietly excluded from the entire trading community's future business. This social pressure, informal as it was, often proved just as powerful as any written law in enforcing honest dealing across long distances. There is a gentle truth woven through this entire history, worth carrying with you as you drift towards sleep, that finance, in every century, has ultimately rested less on gold than on the patient, fragile, endlessly renewed willingness of people to trust one another. Currency itself has taken many strange and unexpected forms across human history, long before coins or paper ever existed, each shaped by whatever a community agreed to trust.
Ancient Chinese communities once used cowrie shells as a medium of exchange, their durability and natural scarcity making them a convenient, portable store of value.
In parts of West Africa, cowrie shells remained in active use as currency well into the 19th century, traded alongside European coin in busy coastal markets. Roman soldiers, according to popular tradition, were sometimes said to receive part of their pay in salt, a valuable preservative in the ancient world, giving us the modern word salary. Even something as ordinary as a small white shell or a pinch of salt, it turns out, could once carry the same quiet weight of trust that a banknote carries today. Imagine the great trading civilizations of Mesoamerica, where the Aztec Empire developed its own sophisticated system of exchange using cacao beans as a widely accepted form of currency. Cacao beans were light, easily divided into small units, and universally valued for the rich chocolate drink they could produce, making them ideal for everyday transactions across the empire. Aztec markets, particularly the enormous marketplace at Tlatelolco, hosted tens of thousands of traders daily, with officials carefully overseeing fair pricing and honest dealing. Yet cacao, unlike gold or silver, could be grown, meaning its value depended on careful management of supply rather than natural scarcity alone. There is something quietly delightful in imagining an empire's entire economy resting, in part, on the same beans that would one day become the world's chocolate, value found in the most unexpected, edible places. The Inca Empire, by contrast, developed a remarkably sophisticated economy with almost no currency at all, relying instead on an elaborate system of labor obligation and centralized redistribution. Citizens contributed labor to the state, working on roads, farms, or state storehouses, and in return received food, tools, and support during hardship directly from those same storehouses.
Careful record keepers used an intricate system of knotted cords called quipu to track these obligations and contributions across the vast Andean Empire.
Yet without a portable universal currency, everyday trade between distant communities remained more limited than in currency-based economies elsewhere in the world. It is a quietly fascinating reminder that trust and exchange throughout history have never required money in the way we usually imagine it. Sometimes a knotted cord and a shared sense of obligation was more than enough. The Silk Road, stretching from China to the Mediterranean across thousands of miles of desert and mountain, required its own distinctive financial innovations to keep trade flowing safely across such vast and dangerous distances. Merchants along these routes developed early forms of credit and partnership, sharing both the risk and the profit of a journey that might take years to complete.
Caravanserais, fortified rest stops spaced along the route, often served as informal centers for trade, currency exchange, and the safekeeping of goods overnight.
Political instability along any single stretch of the route could disrupt trade for the entire network, a fragility that merchants manage through diversified routes and careful distributed partnerships. Even across the harshest deserts and highest mountain passes, this ancient thread of trust connected civilizations that might otherwise never have known one another existed.
In medieval Northern Europe, a powerful alliance of trading cities known as the Hanseatic League built its own remarkable financial network stretching from London to Novgorod.
Member cities, including Lübeck, Hamburg, and Bruges, cooperated to protect trade routes, establish common trading standards, and extend credit to merchants moving goods across the Baltic and North Seas. The League maintained trading posts called contours in foreign cities, each operating almost as a small, self-governing merchant colony with its own financial and legal practices. Yet, as centralized nation-states grew stronger across Europe in the following centuries, the loosely organized Hanseatic League gradually lost its influence and eventually dissolved. There is a quiet lesson in the League's long, slow fade, that even the most successful trading networks eventually give way to whatever new form of trust and order history decides to favor next. Venice, perhaps more than any other medieval city, built its entire identity around trade and finance. Its narrow canals lined with the counting houses of merchants trading across the Mediterranean world.
Venetian bankers operated from benches near the Rialto Bridge, and the city passed some of Europe's earliest formal banking regulations, requiring licensed bankers to maintain adequate reserves.
The city also pioneered government bonds, encouraging citizens to lend money to the state in exchange for regular interest payments, an early ancestor of the modern government bond market.
Yet, even Venice's careful regulations could not prevent occasional bank failures, particularly when war or plague disrupted the delicate rhythms of Mediterranean trade.
There is a quiet grandeur in imagining this floating city, built on wooden pilings sunk into a lagoon, somehow also becoming one of history's great laboratories for the modern idea of public debt. In neighboring Genoa, another great maritime republic developed one of history's most remarkable financial institutions, the Casa di San Giorgio, founded in the early 15th century. This institution consolidated the Republic's public debts into a single organized fund, allowing citizens to buy and trade shares representing a claim on future government revenue.
The Casa di San Giorgio eventually took on such influence that it managed some of Genoa's overseas colonies directly, blending public finance and governance in a way still studied by economic historians today.
Yet, like so many powerful financial institutions before it, its fortunes rose and fell with the shifting tides of Genoese politics and Mediterranean trade.
Even now, centuries later, historians still quietly debate whether this Genoese institution deserves to be remembered as one of the world's very first modern banks. Imagine a young apprentice in 17th century London, indentured for 7 long years to a goldsmith banker, learning the careful, patient craft of assessing coin, keeping ledgers, and judging a client's trustworthiness. Banking, for most of its history, was learned this way, not in a classroom, but through years of quiet observation beside an experienced master. Apprentices gradually earned greater responsibility, moving from simple errands to handling small transactions, and finally to judging credit risk on their own. This slow, patient training shaped generations of bankers who valued caution and long relationships over quick, unfamiliar profit. So over time, as banking modernized, this apprenticeship tradition gradually gave way to formal education, though the underlying lesson, that trust is earned slowly, never really changed at all.
Life insurance developed more slowly than its marine and fire counterparts, since placing a monetary value on human life felt, to many people across history, uncomfortably close to gambling on death itself.
Early forms of life insurance existed among Roman burial societies, which collected regular contributions from members to cover funeral costs when a member died.
Modern life insurance began taking clearer shape in 18th century Britain, gradually building actuarial tables based on careful, patient study of mortality patterns across large populations. These tables allowed insurers to calculate fair premiums scientifically, transforming what once felt like superstition into a careful mathematical discipline. There is something quietly tender in this particular corner of financial history, an entire industry built around the gentle, practical wish to soften a family's hardship after losing someone they loved.
The simple household ritual of saving coins in a small clay or ceramic container stretches back much further than most people realize, appearing in archaeological sites across many ancient cultures.
Some historians trace the popular piggy bank shape to medieval Europe, where a common orange clay called pig was used for household jars, later reimagined playfully as a pig by potters. Long before children in the modern world dropped coins into a ceramic pig, ancient households in ancient Greece, Rome, and China kept similar small vessels for storing modest savings safely at home. These humble containers represent perhaps the oldest and most personal form of banking in history, requiring no institution at all beyond a family's own quiet discipline. Even the grandest financial systems this evening has described all rest, in the end, on this same simple, patient habit, setting a little aside today in gentle trust of tomorrow. Mathematics and banking have always walked closely together, and few figures illustrate this better than the medieval Italian mathematician Leonardo of Pisa, better known as Fibonacci. Having grown up around his father's trading post in North Africa, Fibonacci learned the Hindu-Arabic numeral system used by Arab merchants, far more practical for calculation than the clumsy Roman numerals still common in Europe. His 1202 book, the Liber Abaci, introduced these numerals to European merchants and bankers, along with practical methods for calculating interest, currency exchange, and profit. This single book quietly transformed how European commerce handled arithmetic, laying essential groundwork for the increasingly complex banking calculations of the centuries that followed. There is a quiet wonder in realizing that the very numbers we still use today to balance a modern bank account first arrived in Europe through the patient, careful notes of a traveling merchant's curious son. Imagine the mines of Potosi, high in the mountains of what is now Bolivia, where colonial Spain extracted a staggering quantity of silver beginning in the 16th century. This single mountain of silver ore helped fund the Spanish Empire for generations, its coins circulating from Manila to Madrid, forming an early truly global currency. Yet the mines extracted this wealth through brutal forced labor systems imposed upon indigenous and enslaved populations. A profoundly difficult chapter that honest history cannot look away from. The immense human cost behind Potosi's silver stands as a somber reminder that behind every gleaming coin in history, there often lies a story of real people and real suffering. It is important, even in a gentle telling of financial history, to hold this truth quietly alongside the wonder that great wealth has too often been built upon great and unacknowledged cost.
Across medieval West Africa, the wealthy Mali Empire built its own extraordinary reputation for gold, most famously through the legendary pilgrimage of Mansa Musa to Mecca in 1324.
Historical accounts describe Mansa Musa distributing such vast quantities of gold along his journey that he reportedly disrupted the value of gold in Cairo's markets for years afterward. His empire controlled significant portions of the trans-Saharan gold trade, connecting West African goldfields to markets across North Africa and the Mediterranean. Timbuktu, one of Mali's great trading cities, became renowned not only for gold and salt trade, but also as a center of scholarship and careful, literate record-keeping. There is a quiet grandeur in imagining this empire's wealth, traveling by camel caravan across the vast Sahara, carrying trust and gold together across one of the harshest landscapes on earth.
Bankruptcy! The formal legal process for handling a debtor unable to repay what is owed developed gradually across history from far harsher earlier practices.
In ancient societies, defaulting debtors sometimes faced slavery, imprisonment, or even death, a stark contrast to the more structured protections that slowly emerged in later centuries.
Medieval Italian city-states developed some of the earliest formal bankruptcy procedures, allowing a failed merchant's assets to be divided fairly among creditors, rather than settled through violence or servitude.
Over the following centuries, many nations gradually developed laws allowing an honest but unfortunate debtor a genuine fresh start, rather than a lifetime shadowed by unpayable debt.
This is what makes it so quietly humane, that societies, over many patient centuries, slowly chose mercy and structure over the harsher instincts that once governed how debt was punished.
As the 20th century progressed, the idea of consumer credit expanded well beyond simple store accounts, gradually giving rise to organized credit bureaus that tracked an individual's borrowing history.
These bureaus allowed lenders to assess a stranger's trustworthiness quickly, using recorded patterns of past borrowing and repayment rather than personal reputation alone. For many ordinary families, this system opened doors to credit that earlier generations, judged only by local reputation, might never have received. Yet it also introduced a new kind of quiet vulnerability, since a person's financial reputation now lived permanently within written records beyond their own control. Even trust itself, it seems, has continued evolving across history. From a neighbor's word, to a merchant's ledger, to a distant, careful record kept somewhere none of us can fully see. Japan's financial history took a particularly dramatic turn during the Meiji Restoration of the late 19th century, as the nation rushed to modernize its economy after centuries of relative isolation. Before this period, Japan had relied on a complex network of feudal rice-based accounting and merchant houses, some dating back centuries, to manage credit and exchange. The new Meiji government established the Bank of Japan in 1882, deliberately modeled on European central banks, while also encouraging the growth of large industrial and financial conglomerates known as zaibatsu.
This rapid transformation allowed Japan to build a modern financial system within just a few decades, an extraordinary pace compared to the centuries such development had taken elsewhere.
There is a quiet, striking lesson in Japan's story, that while trust in banking usually builds slowly, a determined society can sometimes compress centuries of patient development into the span of a single generation. Imagine a small crowd of brokers gathering beneath a buttonwood tree on Wall Street in New York City in 1792, agreeing among themselves on basic rules for trading securities. This simple, informal agreement, later known as the Buttonwood Agreement, is often cited as the founding moment of what would eventually become the New York Stock Exchange.
The agreement established basic principles, including a commitment to trade only among fellow signers and to charge standardized commissions, bringing early order to what had been a chaotic, unregulated market. Over the following century, this modest beginning grew into one of the most influential financial institutions in the world, its trading floor eventually moving indoors to a building on the very same street.
It is a quietly humbling thought that one of history's great financial institutions began with nothing grander than a handful of merchants and a simple handshake beneath a tree. The design of banknotes themselves carries a quiet history of its own, each printed image and portrait reflecting what a nation hoped its citizens would associate with trust and stability. Early banknotes often featured allegorical figures representing commerce, agriculture, or the nation itself, rather than specific historical individuals. Over time, many countries moved toward featuring respected historical or founding figures, hoping their reputation might lend a quiet, borrowed credibility to the paper itself. Security features grew steadily more elaborate across the centuries. From simple watermarks to intricate engravings, each new innovation meant to stay one careful step ahead of forgers.
Even the smallest details on a banknote, easy to overlook in a hurried transaction, quietly carry centuries of accumulated effort to make a simple piece of paper worthy of trust.
As colonial empires dissolved across Africa and Asia throughout the middle of the 20th century, newly independent nations faced the urgent task of establishing their own central banks and national currencies for the very first time.
Many former colonies had previously used currencies tied directly to their colonial rulers, leaving newly independent governments with limited experience managing monetary policy on their own.
Building a trusted new currency required careful, patient work, often supported by international advisors and institutions eager to help stabilize these young economies.
Some nations succeeded remarkably well, while others struggled through years of inflation and instability as they built these new institutions from the ground up.
There is a quiet echo here of banking's very oldest lesson, playing out again in the 20th century, that a new currency, like a new government, must patiently earn the trust it hopes to hold.
The telegraph, and later the telephone, quietly transformed banking's relationship with distance in ways every bit as significant as the invention of coinage or paper money centuries earlier. By the late 19th century, banks could transfer funds and confirm transactions across continents within hours, rather than the weeks or months once required by ship or courier. This new speed reduced certain old risks, like a lost or stolen letter of credit, while introducing entirely new ones, including electronic fraud and impersonation.
In 1973, banks around the world established a new cooperative messaging network to standardize and secure these international transfers, quietly knitting the planet's financial institutions more closely together than ever before.
So, over time, the ancient dream that first stirred in a Mesopotamian merchant's caravan, moving trust safely across distance, had finally arrived at a speed no camel or ship could ever have imagined.
Perhaps no chapter in monetary history illustrates the fragility of trust more starkly than the hyperinflation that struck Germany's Weimar Republic in the early 1920s. Burdened by war debts and reparations following the First World War, the German government printed money at a staggering pace to cover its obligations. Prices doubled within days, then within hours, until stories emerged of workers being paid twice daily and rushing immediately to spend their wages before they lost further value.
Photographs from this era famously show German citizens using stacks of nearly worthless banknotes as fuel or wallpaper, since burning the paper was sometimes more practical than spending it.
Even the sturdiest modern economy, this painful episode reminds us, can unravel entirely once a currency's underlying promise is stretched too far beyond what people can still believe.
Imagine the careful, almost surgical currency reform that followed years later in West Germany in 1948, when the old, badly devalued Reichsmark was replaced overnight with a new Deutsche Mark. Citizens exchanged their old currency for the new one at a carefully calculated rate, wiping away much of the inflated monetary overhang built up during and after the war. Almost immediately, shop shelves that had stood nearly empty for years began quietly filling again, as merchants regained confidence that money received today would still hold its value tomorrow. This dramatic turnaround became known as the beginning of West Germany's post-war economic recovery, often remembered fondly as an economic miracle. There is a quiet, powerful lesson tucked into this story, that sometimes restoring trust in money requires not gentle patience, but one bold, carefully planned, decisive act. Gold reserves themselves have occupied a strange, almost mythical place in the modern imagination, none more famous than the United States Bullion Depository at Fort Knox, Kentucky. Built in 1936, this heavily fortified vault was designed to hold a substantial portion of the nation's gold reserves securely, away from the more exposed vaults of Wall Street. Its imposing granite walls and legendary security have made it an enduring symbol of national financial strength in popular imagination, appearing in novels and films for generations.
Yet even after the United States abandoned the gold standard for its currency in the 1970s, the gold within Fort Knox remained, a quiet physical reminder of an older monetary age. There is something oddly touching about this, an entire nation still carefully guarding a mountain of gold it no longer strictly needs, out of habit, history, and a certain quiet reverence for the past. Modern Islamic banking, which developed significantly over the second half of the 20th century, offers a fascinating continuation of very old questions about interest and fairness in lending. Rather than charging traditional interest, Islamic financial institutions developed alternative structures based on shared profit, leasing, or partnership, designed to align more closely with religious principles against usury. Institutions offering these services expanded significantly from the 1970s onward, particularly across the Middle East, North Africa, and parts of Asia. This modern movement echoes, in a quiet and distant way, the very same medieval debates that once shaped banking practice across Christian Europe centuries earlier. It is a gentle reminder that questions about the ethics of lending, first debated in ancient temples and medieval monasteries, have never really left the conversation about how money should properly behave. The story of banking, stretched now across 5,000 years, keeps returning again and again to the very same handful of quiet, human truths. Every clay tablet in a Mesopotamian temple, every coin stamped by a Lydian king, every ledger kept by candlelight in Florence or Amsterdam, rested on nothing more solid, in the end, than one person's willingness to trust another. Institutions rose, and institutions fell. Kings defaulted, bubbles burst, and empires printed their currencies into worthlessness. Yet somehow, each time, human beings quietly rebuilt the practice of trusting one another with their savings. Perhaps this is banking's truest lesson, gentler than any of its crises or collapses, that trust, however fragile, has always proven remarkably patient and renewable. This is what makes the whole long story so quietly comforting to rest upon tonight. Not its grand institutions, but this simple, enduring, deeply human habit of choosing, again and again, to believe in one another. Compound interest, the quiet mathematical idea that interest itself can earn further interest over time, has fascinated and worried thinkers since antiquity, long before anyone called it by that name. Babylonian mathematicians left behind clay tablets calculating how debts might double over a set number of years under compounding terms, a calculation that would look familiar to any modern accountant. Medieval scholars, wary of usury, viewed compound interest with particular suspicion, since it seemed to make money grow almost as if it were alive, multiplying without any real labor behind it. Later economists came to appreciate compound interest as a remarkably powerful, patient force, capable of transforming modest, regular savings into substantial wealth across a long enough span of years. There is a quiet, almost meditative beauty in this mathematical truth, that patience itself, applied steadily over decades, can accomplish what no single dramatic fortune ever could. Imagine 19th century immigrants arriving in a new country, often carrying little more than a small bundle of belongings and the hope of sending money home to family left behind. Immigrant savings banks sprang up in port cities like New York and Liverpool, specifically designed to help newcomers safely save and remit small sums across the ocean to relatives still waiting. These modest institutions understood, better than grander banks, how deeply personal and how quietly urgent a small remittance could be to a family thousands of miles away. Remittance networks continued evolving throughout the following century, eventually growing into vast global systems moving money between family members across every continent on Earth. Even the grandest architecture of international finance, at its heart, has often simply been this: one person, far from home, finding a trustworthy way to care for those they love. Canada's banking history offers a particularly interesting contrast to its southern neighbor, having weathered the Great Depression with remarkably few bank failures compared to the thousands that collapsed in the United States. Canada's system relied on a small number of large, nationally branched banks rather than thousands of small, independent local institutions vulnerable to isolated local shocks. This structural difference meant that trouble in one region could often be absorbed by the broader strength of a bank's operations elsewhere across the country. Economists have studied this contrast for decades, using it as a quiet case study in how a banking system's basic architecture can shape its resilience during hard times. There is a gentle lesson in this comparison, that sometimes the wisest financial choices are not the most exciting ones, but simply the ones built with quiet, deliberate caution from the very beginning. Scandinavia experienced its own serious banking crisis in the early 1990s, as Sweden, Norway, and Finland each faced steep property market declines following years of rapid credit expansion after financial deregulation. Banks across the region found themselves holding large volumes of loans that borrowers could no longer repay, threatening the stability of each nation's financial system. Rather than allowing panic to spread, these governments intervened decisively, temporarily nationalizing troubled banks, guaranteeing deposits fully, and working through bad loans in an orderly, transparent manner. Within a few years, the Scandinavian banking systems had largely stabilized, and the episode became widely studied as a relatively successful example of crisis management. So over time, this quiet Scandinavian response became something of a model for later crises elsewhere, a reminder that decisive, transparent action often heals confidence far faster than delay or denial. Trust companies emerged as a distinctive institution in the 19th century United States, originally designed to manage estates, trusts, and other assets requiring careful, impartial fiduciary oversight. Over time, these companies expanded well beyond their original purpose, increasingly accepting deposits and extending credit much like ordinary banks, though often with looser regulation. This lighter oversight made trust companies attractive to depositors seeking higher returns, but it also left them more vulnerable during moments of financial panic, as the events of 1907 painfully demonstrated. Following the reforms that created the Federal Reserve, trust companies gradually became more closely regulated, blending further into the broader, more unified banking system. Even institutions built for the careful, quiet management of family wealth, it turns out, could not entirely escape the same old temptations and dangers that had always haunted banking itself. New York's private clearinghouse, established by the city's banks in 1853, offers a quietly fascinating example of an industry regulating itself before formal government oversight fully caught up. Member banks used the clearinghouse to settle the countless checks and debts owed between them each day, using specially issued clearinghouse certificates during moments of unusual strain. During several 19th century panics, including the crisis of 1893, the clearinghouse even issued its own emergency currency, effectively acting as a private, informal central bank before the Federal Reserve existed. This system worked reasonably well for smaller crises, but the Panic of 1907 finally revealed its limits, as we heard earlier tonight beside Pierpont Morgan's crowded room. There is a quiet, patient logic in how history often works. Private solutions holding steady for a while, until finally a crisis large enough arrives to demand something sturdier and more permanent. Imagine the great cathedrals of medieval Europe, structures that sometimes took a century or more to complete, financed not through any single grand donation but through centuries of patient, pooled contribution. Towns issued informal appeals, collected regular donations, and sometimes sold indulgences or small commemorative tokens to fund the enormous cost of construction across many decades. Guilds and wealthy merchant families often financed entire chapels or sections of these buildings, their names and symbols quietly worked into stained glass and carved stone. This patient, generational financing shares a quiet kinship with modern infrastructure bonds, both resting on the same basic idea that some projects are simply too large for any single lifetime and must be built on trust passed carefully forward between generations. There is something deeply comforting in this thought as you drift towards sleep tonight, that some of humanity's most beautiful, enduring structures were built not by hurried wealth, but by centuries of patient, quiet, collective saving. The grand marble halls and towering columns of many historic bank buildings were never accidental in their design, but carefully intended to project permanence, safety, and quiet, unshakable strength. 19th century architects often modeled bank buildings after ancient temples, borrowing the same visual language once used for sacred spaces to suggest that a depositor's trust was, in its own way, equally sacred. A customer walking into such a building, surrounded by thick stone walls and heavy bronze doors, could feel reassured simply by the weight and solidity of the architecture itself. Yet these same grand buildings sometimes concealed banks whose actual financial health was far less solid than their marble facades suggested. It is a quietly telling detail from history, worth remembering gently, that trust, however carefully built in stone, has always ultimately depended on something far less visible than any building's walls. Dividends, the regular payments a company makes to its shareholders from its profits, trace one of their earliest well-documented histories back to the Dutch East India Company in the early 17th century. The company began paying its investors a share of profits from successful voyages, sometimes in spices rather than coin, during its earliest years of operation.
This steady, reliable payment helped establish investor confidence in the still novel idea of owning shares in a distant, risky trading venture. Over time, the promise of regular dividends became a cornerstone of how ordinary people came to trust and participate in the wider world of stock ownership.
there is a quiet thread connecting that first spice-based dividend paid to a cautious Amsterdam merchant 4 centuries ago, to every small, patient investor still quietly building their own modest savings today. If banking has a quiet, hidden purpose beneath all its ledgers, vaults, and grand marble buildings, perhaps it is simply this: the patient work of remembering. A bank remembers, on your behalf, what you have earned, what you have saved, and what you are owed, so that you yourself do not have to carry that burden every waking moment. Across 5,000 years, from clay tablets to leather-bound ledgers to careful modern records, this quiet act of remembering trust has taken countless different forms. Yet its purpose has never really changed, freeing each of us, in some small way, to rest a little easier, trusting that our small portion of the world's wealth is being carefully, faithfully kept. Perhaps that is the gentlest way to carry tonight's long story into your dreams, not as a history of money at all, but as a quiet, patient history of people learning, again and again, how to hold each other's trust with care. The concept of a run on a bank, so central to many of the crises we have wandered through tonight, rests on a strange and quietly fascinating psychological puzzle. A bank holding your deposit is, by design, only keeping a small fraction of it in ready cash at any given moment, the rest already lent out to others. This arrangement works perfectly well as long as depositors trust the bank enough not to all demand their money back on the very same day. Yet the moment enough people begin to doubt that trust, their fear alone can make the very disaster they feared come true, regardless of how sound the bank's underlying finances actually were. There is a quiet, almost philosophical lesson tucked inside this pattern, that in banking, belief itself is never just a reaction to reality, but very often a force that quietly shapes reality in return. Imagine the founders of the earliest deposit insurance schemes, working through the details of exactly how much protection to offer, and to whom, in the anxious years following the Great Depression. Too little protection, they worried, would fail to stop the panics that had devastated so many communities across the country. Too much protection, others cautioned, might encourage banks to take reckless risks, since depositors would no longer feel the need to carefully judge a bank's soundness for themselves. This careful, ongoing balance between protecting depositors and preserving healthy caution remains a quiet, unresolved tension in banking regulation, even today. It is a patient reminder that even our safety nets, however carefully designed, always carry their own small, quiet trade-offs tucked gently within them. Throughout this long evening's journey, one pattern has appeared again and again in nearly every century and every corner of the world we have visited together. Wherever human beings have gathered to trade, to build, or simply to plan for tomorrow, some quiet form of banking has followed close behind, however humble its first appearance. From a Mesopotamian grain receipt to a Florentine bill of exchange, from a Scottish savings bank to a village lending circle in West Africa, the underlying instinct has always been the same. People have always wanted a safe place to set something aside, and a trustworthy way to share what they had with someone who needed it more in that particular moment. So, over time, this instinct has worn 1,000 different disguises across history, yet never once has it truly changed at its quiet, patient core. As you rest here tonight, somewhere in the world a bank vault stands quietly locked, a ledger sits patiently updated, and countless small promises continue circulating gently between people who will likely never meet one another. A farmer's harvest loan in one country, a family's modest savings account in another, a merchant's letter of credit crossing a border on some distant morning, all part of this same unbroken thread stretching back through everything we have wandered through tonight. None of these small, quiet transactions feel particularly dramatic in the moment, and yet together they form the very fabric that has allowed civilizations to plant this year's harvest with confidence in next year's, and to build for children not yet born. There is something deeply settling in this thought, worth carrying gently with you now, as your own thoughts continue to slow. This is what makes the whole long story so quietly worth resting upon tonight. Not any single dramatic crisis or triumph, but the patient, unbroken, endlessly human habit of trusting one another just a little further into tomorrow. Before we begin gently closing tonight's story, consider one final, quiet thread that runs beneath everything else we have wandered through this evening. The simple act of writing something down. Every innovation in this long history, from clay tablets to bills of exchange to modern digital ledgers, has ultimately rested on the same basic human impulse to record a promise so it might outlast memory alone. A spoken promise between two ancient traders could be forgotten, disputed, or quietly denied once the moment had passed and only memory remained. But a promise carefully written down, whether in cuneiform, ink, or careful modern record, could travel across years, across generations, even across the fall of entire empires. There is a quiet, gentle comfort in this thought as you drift further towards sleep tonight. That trust, once carefully written down, has always had this remarkable, patient power to outlive the fragile moment in which it was first spoken. And so we come, gently, to the end of tonight's long, slow river of history, from clay tablets in ancient temples all the way to the quiet, invisible networks moving trust across today's world. Every marble bank, every humble village lending circle, every collapsed bubble, and every patiently rebuilt institution we have wandered through tonight shares this same fragile, resilient thread running quietly beneath it. Civilizations rise and fall, currencies are debased and restored, and yet somewhere, always, someone quietly agrees to trust someone else with what they cannot carry alone. Let that thought settle over you now, soft and unhurried, as your own breathing continues to slow and the room around you grows quieter still. Let this be where tonight's story gently comes to rest. We have traveled together through 5,000 years of trust, from clay tablets in the temples of ancient Mesopotamia, through the crowded, sunlit stalls of Athens and Rome,
into the quiet counting houses of Florence, Antwerp, and Amsterdam,
across the marble halls of London and New York, and finally into the vast, invisible networks that carry money softly across today's sleeping world. We have sat beside Medici clerks bent over candle-lit ledgers, beside frightened depositors gathered outside failing banks, beside patient village savers dropping coins into a small clay jar. Kings broke their promises, and empires printed their currencies into dust. And still, somehow, ordinary people kept quietly choosing to trust one another all over again. That is the real story beneath all of tonight's ledgers and coins. Not gold, not marble, but the soft, stubborn, endlessly renewable habit of belief between strangers. If your mind is still drifting somewhere between waking and sleep, there is another quiet story waiting for you on this channel whenever you need it. Another slow river of history ready to carry you gently toward rest. If tonight's journey helped you drift a little further towards sleep, it would mean a great deal if you left this video a like, or subscribed for the quiet night still ahead, or simply left a comment about which chapter of tonight's history stayed with you longest. For now, though, there is nothing more you need to do. Let your jaw soften, unclenching gently. Let your shoulders sink a little further into whatever is holding you, and let your breathing settle into its own slow, unhurried rhythm. Picture, if you like, a single quiet lamp in an old counting house, its light slowly dimming as the ledgers close for the night. The great wheel of history turning gently on without needing you to watch it any longer. You have carried enough tonight. You can set it down now and simply rest. Sleep well and good night.